Welcome back, everyone. Michael here with Offshore Citizen. Great to connect with you. Today we're going to discuss the subject of if you're planning on leaving your country, you're going to either, renounce your citizenship, get a new citizenship, move abroad, and you're going to therefore, cut your ties to your country and set up international companies. When is a good time to do that? So we're going to answer all of that coming up. Before, click the subscribe button, click the notification bell. I heard it gives you some sort of special superpowers. All right, let's dive into it. So this comes up actually quite a lot. A lot of people ask me about this. And the subject is basically, let's say that you're living in Canada, you're living in Australia, you're living in Germany, you're living in UK, in France, in Spain, wherever, and you're going to be moving abroad, okay? Now, when you move abroad, and I'll do a video on this in the future, but you're going to have to cut your ties with your previous country in order to not be a citizen, not to be a tax resident there, in most cases. Okay, so let's say you're going to move to Thailand, you're going to move to Malaysia, you're going to move to Malta or Cyprus or somewhere in Eastern Europe or wherever else, right? Wherever it is you're deciding to move. So the question then becomes, when do you set this up? And this actually has some really important consequences that vary country to country, but is something that you should be aware of. Okay, so let's say that I decide, okay, I'm going to set up a foreign company, right? And I'm going to get my banking going, I'm going to get my payment processing going, I'm going to shift all my clients over, etc. And then I decide to leave. Well, oftentimes you will have an exit tax when you leave. Not always, it depends country to country, but often you will have an exit tax, okay? If you have an exit tax, then you're going to be in a situation where now the new company that you set up, you're going to have to assess the value of that company and pay tax on basically as though there's a deemed disposition. So again, I'll do a video on exit tax in the future, but this is the situation. So from that standpoint, it's like, well, what's kind of a good timing? And I'm going to give you kind of my loose rule of thumb, and you can kind of keep it in mind. Now, it varies a lot scenario to scenario depending on what situation you're in, but obviously you want to minimize that exit tax, right? At the same time, you can't be in a situation where you say, hey, listen, I'm going to go abroad, then I'm going to go and I'm going to close everything down, I'm going to go abroad, and then I'm going to rebuild everything. Because what could happen there is, let's say you have clients who you have subscriptions with, maybe you're doing some sort of info marketing, that sort of thing. You can't have this gulf of time when you have no structure for them, right? Obviously you have to earn your living, you're going to make your money, etc. So you need to make sure there's a proper transition plan in place. And you want to do that in advance, right? So that it's kind of like what I described is you've got the train on the tracks and you set up another set of tracks next to it and then you just transition over, as opposed to stopping the train, building some new tracks, moving the train on, all right? So that's kind of the analogy that I give. So optimally, what you're going to do is, well, you could really do it in two ways, right? The one way is you say, hey, listen, I'm going to form a new structure in trust, and I'm going to do that where the trust will basically pass over to me when I cease to become a resident. Okay, so that's one way that you could do this fairly seamlessly, but it's also going to be more expensive and it's also going to be more hassle. So does it pay off? I would say it tends to pay off more if you have quite a large company where your deemed disposition could be quite high. Okay, so just consider what the consequences are here. Let's say you're like, all right, I'm going to look at kind of like a worst case scenario, right? Say your company's making $1 million a year, and let's just say, for instance, that the deemed value of the company is, let's say a 3x multiple on earnings. Okay, so it's a $3 million company. So normally what would happen is, when you do your exit, you're going to pay tax as though you had sold a $3 million company, right? So you're going to pay whatever the exit tax is going to work out to depending on your country, right? So, okay, you leave, you pay this tax. Now you have what's called the adjusted cost basis of the company goes up to $3 million, and if you were to sell in the future, you wouldn't pay any tax. And this is true of all assets, actually. You may be in a situation from the perspective of a company where you don't have to pay tax at all, but hypothetically, whatever the asset is, the asset value is going to be reset to the amount that you've already paid the tax on, and if you sell in the future, you're only going to pay a tax on the gap between that amount and the amount over and above it. That's kind of the normal way that it works. Okay, so anyway, well, again, I can do another video on what is adjusted cost basis in the future. Okay, so going through here, we're saying let's say that we build this up and the valuation is kind of backwards looking, right? I transition everything to a new company, right? This new company now, therefore, is basically taking over $1 million a year profit, right? Now, aside from all the complexities of reporting, etc., if I have to report in that same year, I could also end up in a situation where they basically double view this company, right? They say, hey, we've got a $3 million company here, and we see you've got a, looks like $3 million company here. You don't want that, obviously, right? So a couple things could happen. The one is you can set up this structure, you can put all the infrastructure in place, right? But don't shift over everything at that point in time, so that when you're leaving, you're saying it's just an empty company. An empty company is worth nothing, so that's out. I only have to value this company here. Okay, great. Fairly simple, minus the fact that it might be very complex to figure out what it's worth, but that's a whole other conversation. So we go on to the next thing. We say, all right, how about with respect to the next option? The next option is, like I said, we set it up in a trust. You don't own it, therefore it's not one of your assets when you have this deemed disposition, and therefore you can transition. Again, it depends on your situation which one of those would work. You may also say, hey, listen, I'm not somebody who's in a position that I have an existing business, so I don't need to worry about that. Maybe I'm a freelancer, I'm planning on shifting over to some sort of an international structure. Maybe you sold your company and you're going to be leaving, etc. In that case, I would recommend to set up the company after you leave, okay? But being aware of one key thing, which is you're going to want to be able to show the documentation, the KYC, etc., for yourself when you're setting up that new entity. And this can sometimes be difficult when you transition, okay? Because maybe you're renting in a new place and your utility bills aren't in your name or something like that. These things are always, a little bit of a hassle. So anyway, the bottom line is, here's what I would recommend. I would recommend if you have a major setup, then either put the infrastructure in place but don't use it. So basically you're saying, hey, there's no real value there. But you're going to end up doing this. What you actually sometimes end up doing is you sometimes end up actually doing an acquisition where this company buys this company, and that's how the transition ends up happening. So you would seed this company with money, this company is then going to do an acquisition of that company, etc. Which, by the way, you don't inherently have to shut down your existing company. It may be that, let's say you own, I don't know, a chain of franchises, right? You're like, okay, well, my chain of franchises is here, it's going to be here, I want to continue to earn money from that. You can own a company in the country that you were from without a problem, and that may be what's necessary for you, right? You may be in a situation where you're like, okay, yeah, that's what I'm going to do. Of course, I'm going to keep my business is going to continue paying me. Of course, as a foreigner, now I'm going to be in a situation where I'm subject to, say, dividend withholding tax. That's fine, I'm willing to pay it, no big deal, and off you go, right? So there are these different scenarios. So just to kind of recap, and then we'll kind of end it off on this one. One scenario is you say, hey, listen, I don't have anything right now, but I'm planning on setting something up. Well, wait until you're out, or at least don't do anything with it until you're out. A really specific example of this is maybe you're moving to a country where you need to set up a company in order to get residency there. Okay, no problem, but don't run business through there until you're out of the existing system. Okay, so that's situation one. Situation two is you say, hey, listen, what I can do is I'm going to be transitioning from my local company to a foreign company. And so what I want to do is I want to set up the railroad tracks, the infrastructure for the company. And then once I leave, then I'm going to swap it over. That way there's no duplication there. And, if it's a large enterprise, especially if it's an international enterprise, you may be in a situation where you would use some sort of a trust structure for that. And this gets a little bit more complicated, but there are some reasons why that may have some payoff for you, especially if you're thinking far in advance. So if you're thinking far in advance, you say, hey, listen, I'm going to be leaving in 3 years. I want to ease this transition. Okay, you may use a trust structure, right? Which, by the way, it could also apply if you're coming into a country, you're only going to be there for a few years and then you're going to leave. So similar scenario. Last scenario that you may want to deal with is you may be in a situation where you say, hey, I'm just going to maintain my existing company, and that's fine, and I'm going to pay my taxes, etc. That company will be taxed locally. I'll pay my dividend withholding taxes on the distributions. No big deal. Maybe I can supply some services to help to reduce that overall tax burden. Great, wonderful, and off I goes. Anyway, I hope that helps you. Click the subscribe button, click the notification bell to get updated on lots of other cool content. If you would like to kind of get some more details on this sort of thing, reach out to me, offshorecitizen.net, offshorecapitalist.com. Below it, there's a link for clarity.fm/Michael Rosmer if you want to book a call with me. You can go and you can put some comments below if you have some questions or you have something you'd like to see, etc. And yeah, anything that you would like assistance with, happy to hear from you. Would love to know kind of what you think, what you like, etc. And we will talk to you guys on the next video.